Hey, this is Sasha, and thanks for joining me here for another episode on Let's Talk Stocks, where I share with you my own personal take on trading and investing, along with options. And that's what we're going to cover today, is taking a look at calendar spreads, at least the basics behind calendar spreads and how they work and how you make money and profit from them in the marketplace. Now, as we continue through the next couple of weeks, you'll learn a little more about calendar spreads as we go ahead and release our calendar course that'll be coming up soon. So keep your eyes peeled for that and make sure to subscribe to our newsletter if you want to get notified when that is released, along with a promotion deal that will come with that as well. So when we look at calendars, you might be wondering, well, what is a calendar? What does it really mean when I say calendar? Well, all this really means is it's just a strategy. That's really all it is it's just a strategy. It's a name for a type of strategy. Now, the way that options really work is based on time decay. Okay, so options, they all have this thing called a time decay. Things decay with time. Just like if you were to buy baseball tickets, let's say 3 months in advance, you might pay full price for those baseball tickets. If you paid or bought those tickets, let's just say, when the game is starting, people are trying to get rid of those tickets, maybe the scalpers, and you might get those tickets actually at a discount. So this is the same thing that we're doing when it comes to option, is we capitalize based on time decay. And this is how time technically decays, is it decays a little slower at the beginning and faster towards the end, because the value of it is much more here at the beginning and you have a lot less time left. So you're trying to get rid of your stuff way quicker. So let's say this is maybe 120 days. This might be 60 days. This might be 30 days. And as you can see, with 30 days right there, you don't have a pretty slow decay anymore. 30 days, this becomes very quick on the decay. So what you normally do in a business is, if you're doing any kind of business, okay, it doesn't matter what business you're in, you're normally, and I say normally, it's not always the case, but normally you're a seller, okay? You sell things. So let's just say you're Apple. Well, you go ahead and you sell cell phones, right? You make them and then you sell them. If you're selling produce, again, you're selling produce. So you're normally a seller, and options are no different. You're basically selling insurance. So think of it like being an insurance salesman. So what you're doing is you're selling these premiums, and it could be 30 days. Just like if you bought car insurance from a person down the street, or your, Progressive, Geico, whatever the case is, whichever company that you have. If you buy insurance with time, they just collect that premium if you don't get into a car accident. So that's what you're really doing, is you're selling insurance on stocks. Now, what happens with a calendar spread is you're doing so in a way that it also protects you. Because if you just went ahead and just sold insurance, well, what happens if someone actually did get in an accident with their car? Well, you got to pay out. So that's why those companies have this pool of money, or they put protections on themselves in case somebody does get into an accident. Then they can go ahead and cover the damages. And this is what you're doing in a calendar spread, is that we know the decay curve goes much faster 30 days to kind of 0 days. It's a lot slower 20 days to 60 days or to 30 days. So it's much slower and favorable here. So in a calendar spread, what we're doing is, let's just say you have, here is we'll go calls, and then we'll go puts on this side. So here is kind of our spread, and then we have strike prices that are all over here. So what we're really doing is, if we have this 30 days out, and then we have another one 60 days out, and we have another contract set 90 days out, what we're aiming to do when we're trading a calendar is we'll go ahead, and it doesn't matter if you do puts and calls, depends whether, the price is a little higher or lower. You could do puts or you could do calls. But basically, let's just say you go ahead and sell the 30-day, okay, sell one contract at the 30-day strike price, okay, whichever it is, call it, let's just say 180. Okay, and then you go to the 60 days and you buy one. Let's go make it a different color. You buy one for protection. And again, this would be at the $180 strike price. So when you're a net seller of a contract, your profit picture is going to look something like this, okay? Because you're selling a contract. Depends on if you're doing puts or calls, of course. And then if you're buying one, well, it may look something like this, okay? So combining those two together, you get a spread that will actually look, and I'll draw it out for you here, it's going to look something like this. And that's what a calendar really looks like, okay? So when we look at this calendar, and I'll redraw it for you in a second, this is what the expiration curve looks like. And really what you're looking for is to capitalize from selling the 30 days, because you know the 30-day part will decay much faster, and you buy this one, the 60-day, could be 90 days, whatever time frame suits you, for protection. And that way, that decay of that, it still decays, but it's much slower. So therefore, by the time this goes to 0 days, you go ahead and make much more money, because the one at 30 days decays faster than the one at 60 days or 90 days. Now, yes, the 60-day, 90-day, it still decays, but it just decays a lot slower. And that's really what you're doing, is you're selling more time premium at the faster decay rate, and you're buying one at the slower rate, creating kind of a curvature or picture like this. Okay, so here is our profit picture, and these are used to evaluate and analyze risk. And the way that it works is here we have our price of the stock, so $60, $70, $80, $90, $100, $110. And on the left to right or up and down axis, this is our profit and loss. So right here, this line that I've outlined, this is $0 profit and loss. You could say up here might be, let's say, $500. And down here might be, negative $200 profit and loss. So depending on where you fall in this curve, obviously if you're above it, you're going to be profitable. If you're below it, you're not going to be profitable. And what happens here is that this line right here, this is our expiration. Okay, so at expiration of our, let's say, 30-day contract, it's going to look like this. Now our other one, at 60 days still continues to decay, but at expiration at the 30-day, it's going to look like this. Now, we also have a curvature here that happens, and it's going to look something like this. And of course, this will depend on where you're positioning and the price of the position that you're putting on your spread. So if the price is here, it might be over here. It could also be over here, because you could position it a little different. So it really just depends. You could even position it where the price is over here, position the calendar a little more to the right or left. But let's say here is our price, okay? So this is our price of the stock. And what we're looking to do is that with time, because we know the decay is slower on the 60 days, faster on the 30 days, and that line, this line, also known as your T plus 0 curve, okay, which is today, this line is today, and this line is at expiration, the red line here, is that with time, this line, the T plus 0 curve, gets a little bit higher, right? So every day that decays, it might be $5 a day today. The next day, it could be $7, because remember, it's not linear, okay? Our curve on the decay is not linear. It's actually exponential. So you have a little curvature to it. So you might go $5, $7, $8 the next day, $12 the next day, $18 the next day, and that continues to build. So with time, that curvature gets a little bit higher and higher and higher. And depending on where you are in the price, okay, in this range, at this point, you could be up, let's say, $350, okay? At this price over here, if you're only a week in there, you might only be up, let's just say, $100, okay? So it really just depends where you fall in the curve at that time of what you're making. But every day, that slowly decays time and time again. Now, can you get out of it early? Because people always ask, hey, can I just get out of it early if I'm kind of somewhere over here and I see it moving a little to this edge? Yeah, absolutely. You can get out of it early, buying back your contracts or buying back your calendar, and collect the profit that you have there. Of course, you don't maximize it, but that's fine. That's what most people do, is that if you're, let's say, in a 30 to 60 day trade, you might get out of it in 10 or 15 days. You don't have to be in it all the way till the end and try to hit that peak, because that's very rare and more than likely not going to happen. But overall, this is how a calendar works, is that you're making money from the time decay, which is known as the theta, okay, with time, because you're selling premium on a contract that expires and decays quicker, just like a banana decays quicker than an apple, right? You're selling bananas and you have apples as reserves. Well, in that case, it allows you to collect more premium and you have those apples for protection if some people are dying and they need some fruit. And that's what you're really doing, is that with time, that line gets higher and higher to expiration, right? And you're collecting your profits. And as long as that stock kind of stays stable between kind of a nice little range, then you should be okay. Now, if it falls outside of that range, well, then you have your risk and your loss, of course, and you could also get out of that early as well. But this is how a calendar really works. And what's great is you don't really have to pick a direction for a stock. That stock could just go, you could position it to where the stock goes up, you could position it where the stock goes down, or it could just stay right here kind of in the middle and wiggle around. And if it just wiggles around for a few days, well, then you go ahead and collect your premium and you can get out of it early, just as long as you want to. So that's how it works, and that's kind of the basics behind understanding calendars, trading calendars, and getting into them. Now, of course, managing them is a whole different story, when to put them on, how to set them up, and there's many Greeks that go along with it, like delta, gamma, vega, and the theta, which is what we just covered mostly here. But all of those things kind of work together to round out your calendar trade and calendar position. But the baseline is you sell one in the front month and you buy another one for protection in the next month, to where the one in the front month, which could be 30 days, could be 10 days, and it expires much faster than the one at, the later month, which the decay is much slower. And that's really what you're doing to collect your money and premium every single week or every single month, as long as you're putting on these calendar trades. Now, we do have a calendar course that's coming out soon, and if you want to be a part of that and join me in a very detailed understanding of trading calendar spreads, then be sure to get on the newsletter list right over here. Click that button, enter your name and email address when you're there, and you'll get notified when that course is released. Thanks for joining me in this week's little lesson. Hope you found it helpful, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.